Hi everyone, this is Craig, the Options Linebacker. This is the weekend report for Sunday, February 27th. Yes, that's right, spring is just around the corner. It can't come too soon. We'll start out today by looking at the Dow Jones Industrials and the transports. These are the Dow Theory twins. And we can see that last week we were talking about the fact that both of those were in confirmation, making higher highs and higher lows. The transports had finally caught up and cleared that slight divergence, but now we're right back in the mud again because we have the transports now making a lower low below the previous low at the end of January. So we have some non-confirmation between the Dow Jones Industrials, which are still clearly making higher highs, and this is a higher low so far at 12,000. Now, the one thing that's got me concerned about the transports is the fact that we have somewhat of a broadening wedge going on here, is that things begin to get a little bit more unstable as time goes by. So we're going to see an increase in volatility perhaps on the transports. And normally these are bearish chart patterns. Now, sometimes it's hard to draw conclusions with the transports because it just charts in a strange manner. I'll give you an example. At the end of 2007, most of the charts across the stock market were starting to put in lower highs and lower lows as the bear market started. And then if you recall, around the middle part of 2008, we had a small little problem with oil. Oil spiked up to a huge amount, and we were all paying $4 a gallon for gasoline. But remember, at the time, the transports actually drove to a new high during this point. Didn't make sense, especially in light of rising fuel costs, that the transports would actually go higher. So over the past week, we've seen transports take a big dive just because of the situation over in Libya and the status of petroleum. So this is why I don't specifically trade the transports, is sometimes you just can't explain what happens with this. But this is the normal reaction to higher fuel prices for the transports that we've seen in the past week. Now let's do some quick top-down analysis on the index chart, starting with the S&P 500 monthly chart. Now, in this chart, we're clearly in a wave 3 higher, and we're in exactly the same position that we were about a month ago. If you recall, at the end of January, we had that one-day wonder to the downside and was leaving the monthly candlestick in a very vulnerable-looking shooting star arrangement. Well, that cleared over the next couple of days as we continue to rally higher. Now, we're in the same position with one trading day left for the month of February. Right now, it's not showing a shooting star candlestick. The body is above the midpoint. So with one day left to go in February, this could go either way. If it does sink down, that's going to be a fairly ominous signal with a shooting star. Now let's move down to the weekly chart of the S&P 500. Earlier this week, with the price down near 1,300, I had all but pronounced dead this weekly swing that has come off the bottom since the end of August. So far is about 304 points, and I was saying, all right, that's it. But this week turned up a little stronger than I thought, and this weekly swing is not over yet. At least that's not what it's showing on the weekly chart. Now, we'll go over the possibilities in a minute for what the S&P could do this week. Now, I still think that the S&P is due for a weekly retracement. If we look at this, we have the first wave up, second wave down, very normal wave, about 80 to 100 points retracement. And then we've had 304 points to the upside. Now this is wave 3 within the larger wave 3 of the monthly chart. So this is going to be a very strong wave. And this is the concern that I had back in December, was it wasn't setting up very strongly. And we've seen that really since this correction, this small daily correction that we had during November, this has really propelled the price much higher. Again, to create these slingshot movements, what you've got to do is you've got to get everybody convinced that the stock is about to roll over, and you've got to get too many weak hands involved that are willing to go bearish. And that's where you see these very, very strong turns. If you recall, back at the end of August, we had some extraordinarily bearish sentiment in the market. Everybody was convinced that everything was just about to roll over, and that was not hard to see with this double top here, and look like a lower high setting up for much lower prices. And of course, as we know now, the timing was perfect for Jackson Hole, and everybody has been wrong since. Now, last week we did see some negative sentiment show up in the marketplace, but it wasn't all that particularly bad. But as I'll show you in a minute, it did cause a mean reversion as far as fear in sentiment. One of the charts that we brought up last week was the NASDAQ Composite Weekly chart. We showed that we had overhead resistance right up at this level, so it's not surprising that we did see some weakness in the NASDAQ, as usually, as we've shown before, that the first approach to an overhead resistance level is usually met with a little bit of a reaction. And we also talked about this on the Russell 2000, as we have all-time highs just a few points overhead right now. So this is also going to be a little bit of a barrier, at least the first time through. Now, looking at this weekly chart, that's a very strong hammer candlestick, so we might expect to see continued higher prices in here until that high is at least tested. Now, a couple of minutes ago, I talked about a reversion to the mean. What does that really mean? Watch this green line here. This is the 200-day moving average on the VIX. And the mean, reversion to the mean, means that fear or greed can get too far out of whack in either direction. And what will happen is the pendulum will swing back to the middle, kind of the mean of that level of fear in the marketplace. And we can see that through the summer correction, we had some high levels here in the VIX, but it would always revert back to the mean. It's kind of like going away and then coming back home again, just to sort of recharge yourself. And we can see that this happened again and again until we got into September. Remember, September started a very strong rally, and this is the first time where it, on a sustaining basis, dropped below the mean, and then again below the mean, and then another reversion to the mean before it finally went very complacent over the last 3 or 4 months. What we saw this week was very important because we did finally get yet another reversion to the mean. It's very important that when we have this level of complacency, occasionally we're going to get that pullback, we're going to get that reversion to the mean. So this is almost a check mark to say that the rally can potentially continue if it wants to, since it's checked back in at home, and that level of complacency has been reset now. So now let's go down to the daily chart of the S&P 500 and see what's going on here. Again, what we talked about is the fact that we really didn't see any significant lower low coming off of the top. All of this has been a series of higher highs, higher lows, higher highs, higher lows. And so far, this is a higher low. Now, there's 3 obvious possibilities that can happen from this point. There's always 3 possibilities. Stocks can go up, they can go down, they can go sideways. So let's chart out each one of these and see what we would have to know before we can claim that. Possibility number 1 is that the price makes a lower high here and then rolls over, and then we print a lower low. And at this point, it's probably going to have to be below that 50-day moving average. That's going to be fairly significant. That's the red line. Possibility number 2 is that the price continues this rebound and we come up and make a higher high, in which case we're still in the same pattern that we've been in since September, higher highs and higher lows. The third possibility, and the one that I think may be in play, is that we do continue to rebound a little bit, but what sets up is a lower high, but then the price does not continue down to make a lower low. Instead, what happens is we get into a consolidation pattern at that point, and this would set up somewhere in this area here between 1343 and 1300. Now, of course, the question is, how do we know which of those 3 scenarios is going to set up? What we can do is kind of frame in the price and determine what's happening based on what we're seeing. Obviously, we can watch price action. This is the 60-minute chart, and if we start to see the 60-minute chart showing a series of higher highs and higher lows, well, this is just a fractal time frame that eventually the daily chart will follow that 60-minute chart and also very likely start putting in higher highs and higher lows. Something else that we can use is the fibs. We'll start out here from the top, draw it down to the bottom of the move, and then look for a reaction at the 38.2%, 50%, or as far as the 61.8. Now, generally, if it gets over that 61.8, typically it will fill in the entire triangle and go back up and at least retest the high, if not make higher highs. So far, the reaction on Thursday and Friday has come up beyond the 38.2, and based on Friday's move is just above the 50%. So what we're going to look for is to see whether or not the price gets above and beyond that 61.8% retracement, which is right now on the S&P futures right around 1324. Now, just a quick illustration on the flexibility of options. We're experimenting with some of the new weekly options that are out there. Actually, they've been out there for some time, but we're starting to see the potential for how we can really ramp up our returns with these, albeit with a little bit more activity and a lot more chart watching that we're going to have to do versus the standard monthly options that we normally play. So on Friday morning, what we did was we entered a 129, 131 bull put spread. This is a bullish trade, and the price has already run away from that trade. Since it's a credit spread, that's a good thing. So we're already in the black on the trade. So what we're going to do on Monday is actually turn this into an iron condor by adding a call spread up here. So we're defining a profit range, and what I also like about this is that we're showing a 1-to-1 risk-reward ratio on this trade. In this type of market, the opportunity is worthless if you can't manage your risk, and this is job number one. All right, folks, I'm out of time for this week, so spring is right around the corner. Don't give up, and we'll see you next weekend. Take care.